Today's market rally wasn't just about higher stock prices. It reflected a meaningful shift in how investors are interpreting geopolitical risk, growth resilience, and the staying power of this cycle. Markets moved sharply higher after the surprise announcement that the U.S. would indefinitely extend its ceasefire with Iran. That single change removed the immediate fear of escalation, and investors responded quickly. The Nasdaq led the move, rising 1.67%. The S&P 500 gained just over 1%, and the Dow added nearly 0.7%. Volatility continued lower, with the VIX falling below 19. That matters because it suggests this was not simply a short-covering bounce. It looked more like genuine risk appetite returning. But what makes today more interesting is what happened beneath the surface. Oil still climbed more than 2.5%. Gold also rose. Treasury yields moved slightly higher. In other words, markets were buying growth assets while still respecting inflation and geopolitical uncertainty. That combination tells us investors are trying to hold two narratives at once. The first is that the immediate risk of war has faded. The second is that supply disruptions and higher energy costs are still very real. The naval blockade of Iranian ports remains in place, and that means physical oil supply is still constrained. So while markets welcomed diplomacy, they did not price in a full return to normal. This helps explain where money moved today. Technology led all sectors, rising more than 2%. Investors rotated back into large-cap growth names, especially tied to AI infrastructure and enterprise demand. The message there is clear. Institutions still believe earnings strength can offset higher rates and macro noise. At the same time, energy stocks also gained. That suggests capital is not embracing a pure risk-on view. It is hedging growth exposure with commodity exposure. This is a classic barbell setup. Own the sectors tied to growth momentum while also owning areas that benefit if inflation or supply stress persists. Meanwhile, rate-sensitive sectors such as real estate and utilities lagged. That tells us investors remain cautious on anything vulnerable to higher yields or tighter financial conditions. Bitcoin also rallied sharply, adding nearly 4%. That usually signals improving liquidity appetite and a broader willingness to own higher beta assets. So the real story today was not simply optimism, it was selective confidence. Markets are comfortable taking risk, but only in areas where they still see either earnings durability or inflation protection. Now, there are still fragilities here. Oil rising alongside equities can work for a while, but sustained energy pressure eventually feeds into transport costs, margins, and consumer spending. If companies begin guiding lower because of logistics or input costs, today's enthusiasm could be tested quickly. Gold rising while yields also rise is another signal worth watching. Normally, higher yields pressure gold. When both move higher together, it can suggest demand for protection against policy uncertainty, currency erosion, or geopolitical stress. That means some investors are still hedging beneath the surface, even while indexes rally. One open question markets are debating right now is whether today's move reflects a healthy repricing of lower geopolitical risk or a temporary burst of relief before inflation pressures reassert themselves. I'd be curious how you see that balance developing. Is this rally sustainable, or is the market overlooking the cost of elevated energy? Looking ahead, the next test likely comes from earnings season and policy communication. If major technology firms continue delivering strong margins and demand signals, investors may stay comfortable owning growth. But if higher input costs begin showing up in results, sentiment could shift fast. Fed communication also matters. If inflation remains sticky because of energy, rate cut expectations may continue to be delayed. The broader takeaway from today's market reaction is that investors are currently choosing growth over fear, but not abandoning caution entirely. They are buying the upside while still hedging the risks. If you enjoy this type of calm, analytical breakdown of global markets, consider subscribing. I publish regular briefings focused on the deeper forces shaping market behavior. Thank you for spending a few minutes here today. I appreciate you being part of the channel.